guys, welcome back to the Capital Mindset Show. Today's going to be a long time coming, and it's another economics review. So basically, we're going to be talking a little bit about, what are some things that I'm kind of thinking about, for all that's worth, and some of my commentary regarding some, key topics. So I guess we're going to do this in order and structure, so I'm not just blabbering on to you guys. So the first thing we're going to talk about is actually inflation. So I've had some really good questions or comments, and I think I need to do a better job at kind of conveying these ideas. So with inflation, we got to first understand what are we talking about when we talk about inflation, okay? Because there's the street terminology, which is prices are going up. That's inflation. And then there's the textbook or the old school terminology, which is simply the expansion of the money supply. You may have heard this from other people like Peter Schiff. He's technically right when he says that. That yes, inflation is the expansion of the money supply. You listen to Jeff Snyder and stuff like that. So then there's different forms of price going up and the causes of prices going up. Inflation per se, the monetary expansion, does cause, yes, prices to go up. And then when we conclude, or when we look at also velocity of money and et cetera, in tandem with one another, then we can see what effect that may have. So inflation that we're seeing today, a lot of people attribute it to money printing. Money printer go burr. You've seen those memes. And that's actually incorrect. Okay, so if you want to say that we are printing money, we have to first then let's get down to questioning that, right? All right, so if the Federal Reserve is printing money, how much money have they printed? Well, they've printed apparently more than half or more than 20% of all US dollars in 1 year. And so in extension, if we should see that as monetary inflation, we should see an inflation level close to that, somewhere close to that. So then we don't really see that, right? Because let me kind of get into the crux of it. I want you guys to grab everything that we discuss, grab QE, and then with your scissors, your mental scissors, cut it off, right? Cut it off, put it to the side, okay? Okay, so if we're going to talk about prices going up, we go back to the basics of supply and demand, right? Basic economics. So if demand is at a certain level and supply is at a certain level, the changes between the two factors causes price fluctuation. So for example, if demand goes up, but supply remains the same, prices will go up. If supply comes down, demand rate remains the same, prices go up, okay? So think about it like that, okay? And then when we take into account the government spending, fiscal spending, all that yes can be inflationary over the short term. We won't have the discussion of what the implications are long term, because one step at a time. So in this video, what I want to focus on is the effects over the short term. So if government is spending money in X thing, okay, well, what does that implicate? What does that mean for us? Okay, so that means that resources are being allocated in a certain manner. The government, the centralized authority, doesn't have the ability to allocate resources effectively. I think at this point, everyone can kind of agree on that. So if they are spending money in certain ways or certain aspects, then we will see misallocation of resources. And this is something I always talk about as being a very bad thing. Misallocation of resources is something that is very difficult to measure in the moment, but the problems when they manifest are really big. So think of 2008, 2000, I know buzzwords, but that's kind of what we have to think about with misallocation of resources. That's what occurs. And usually, not usually, almost all the time, it's always because the incentives aren't aligned. So what occurs is it has to be a centralized authority who is almost removed from the system that is basically pushing on the scales and deciding where resources go. And then you can kind of see this with the bill passed in like 1996, its relationship to 2008. And also with regards to 2000, you could see what the Federal Reserve was kind of doing with interest rates at the time. Okay, and then that kind of gets into a whole little mess about interest rates, Federal Reserve, Jeff Snyder's work, which is really, really good work he does over there at Alhambra Research. But for the most part, I want you guys to, again, cut out QE, because QE is basically an asset swap. And I know it's difficult to kind of explain this in a short or concise manner, but basically QE is a swap between the banks and the Federal Reserve, right? And all they do is they're switching an asset. No money is actually being created at all. And reserves aren't actually tradable. They're not exchangeable. You can't go to the grocery store and buy reserves. The banks have to continue lending. Lending from the commercial banks is where money's actually created and actually sent into the system. But if lending growth is coming down, which it is, then money is not actually being created. And that's the problem. So Japan's having that problem too. Japan's been doing QE forever. What happened to their inflation? What's going on with their inflation? It's not there, because QE is just an asset swap. Now, if they change the rules up and they say central bank digital currency, oh yeah, then you're going to be basically printing money, because now you're changing the relationship between you and the Federal Reserve. At this very moment, You don't have a bank account with the Federal Reserve. The bank account, the Federal Reserve reserves aren't going to you and you can't spend them. However, if we make the reserves currency, then all the rules change. Everything I just said, throw it out the window, because now we're going to start printing money. So I came from a country, Venezuela. We actually printed money. Okay, when you print money, yes, you have hyperinflation. Okay, that's when you'll actually feel it, when we actually start to print money. At the present moment, the Western world does not print money. They all function more or less the same way. You borrow money, right? You create a debt instrument that cancels out in the future, and you don't actually have control over creation of new dollars without any liability. So when you create an asset and then you create a liability, you balance it out. You haven't actually printed. Printing is when you create the asset, the currency, and you don't actually create the liability that kind of cancels out with the asset. So that kind of covers a little bit about inflation. A lot of inflation that we're seeing now is honestly, a lot of it is supply chain. It is supply chain and it's fiscal spending, misallocation of resources. So if the government borrows a ton of money, grabs this money and spends it in a certain way, gives out universal basic income, all of this stuff, yes, that is very inflationary. Okay, that can be very inflationary because again, we don't appreciate what misallocation of resources does to the economy. It's very difficult for us to appreciate it in the moment. However, afterwards, we kind of look back and we say, oh, well, that was a bad idea. But, you know, in the moment, we don't really kind of measure it. So we are seeing the effects of 2020 and 2021 now. Okay, so yes, it is supply chain and also fiscal spending. QE actually does not cause inflation, price inflation. I'm talking about price inflation. It may affect psychology, and Jeff Snyder does a fantastic work at explaining this, and what the Federal Reserve has as power is mainly psychology. It's a really interesting work. I actually recommend you guys go listen over to him. All right, so now we're going to get into the crux of kind of what's going on and what the scariness of, not scary, because I want to actually segue or take a pause here and say, you shouldn't really invest entirely based off of macro analysis. You should use macro analysis and then kind of, it's very difficult to do, but you have to be able to separate it when necessary. So a good way of kind of thinking about it is just go out and invest in companies that are solid and then don't worry about anything else. That's kind of Buffett's lesson to everyone. He's kind of saying, if you're going to overanalyze and you're going to hyperanalyze and you're going to get cold feet. I enjoy reading this. I enjoy learning about macro, and I find ways in which I can actually profit from macro. But you see me right now, I'm saying all the things I'm saying, but my portfolio is now public. I'm not selling everything. Okay. So I am making that separation. I am taking it with nuance, right? The theme of this channel. So nuance. So now let's actually get into, I guess, the inflows and talk about what's kind of going on with the markets there. So I just want to make sure everyone understands that everything I say, do not confuse it with me saying you have to sell everything. Everything is going bad. No. It's just things that we have to think about and consider. Okay. And so we're not surprised or caught off guard. So this is actually, let me actually zoom in here, make it bigger. So over the past, I guess, measures of this, right? This is from Bank of America, by the way, if you guys want to go see where this information is from, I have it cited right down there. So this is actually showing us the 12-month inflows, right? The 12-month flows to equities, okay? So we're seeing a massive flow into equities. And this is interesting because where are we now? Where is the S&P 500 at now? So if I show you guys that, we'll just take a look at the SPY. And I'll show you this real quick. So if you take a look at the SPY over the past 5 years, we are pretty much at all-time highs. When we take a look at the max, we see a lot of inflows in 2021. Okay. So we are above trend line in terms of stock performance. Stock performance is way above trend line. Okay. And is this concerning? A little bit, because what we know is it tends to be when when a bunch of people are greedy, we should start to be a little bit fearful, right? Be greedy when I was fearful. And now it kind of makes sense. Buffett's stance, right? He's kind of like waiting. He's kind of like, what's going on? He has a lot of cash. He has less cash than people realize because you have to consider the insurance business and all that. But he has cash. He has a decent amount of cash. So he's waiting to find these elephants, right? Because he talks about that, the elephant gun. At his size, he has to do that. But for the most part, he's kind of just waiting around and kind of seeing what's going to go on with the US market. And we see a ton of inflow. So again, we're seeing everyone's being a little bit greedy there. All right. And then from there, I want to show you guys the weightings, right? So if we take a look at the S&P 500, their weightings are quite interesting at this point. So This is publicly available information. This is not something that's, anyone can't find. So this is actually the top 10 holdings. So Apple being number 1 and 10 being JP Morgan Chase. I want to actually clarify, or just in case anyone doesn't know, the way the S&P 500 works, VT, all these index funds is they're market cap weighted. They're market cap weighted indexes, right? Oh, and by the way, that's not the same thing. I'm saying index and ETFs, but the index is market cap weighted. So as the price goes up, as the market cap rises, the weighting will go up. So you can see it in clear picture here. Apple has the largest market cap, therefore it has the highest weighting. Microsoft is the second highest market cap, therefore has the second highest weighting. And that's how it functions. It's not based on, P ratios, price free cash flow, discounted cash flow. Now, it's not based on any of that. It's simply based on price go up. If price goes up, it gets in there. Tesla is the 6th largest position, almost 2% of the portfolio. And it's also the 6th largest company. Okay. So that's kind of an important note to keep in mind. And if you take the top 5, well, really the top 4, you're around 20 something percent of the index, right? Which is kind of startling. And everyone knows, for example, I'm a good holder of Alphabet. Okay. I hold Alphabet and Meta. Of these companies, that's the ones I own. I also own Amazon, but Amazon is not really a big position. I've already taken my profits a lot out of this company. So it's kind of like a remaining position of like, I think 2%, 1%, something like that. But Meta is the one I've been buying almost daily at this point, and I'm just growing the position. But Alphabet by far is my largest holding. So, I have benefited from these inflows, and these inflows have been concentrated because if we look at the SPY and we go back to that, we can kind of see that it's actually at it's not really down at all. And a lot of other companies are down. So we are kind of in a quasi bear market, we could say. Let me pull this up here. All right. And hold on, let me fix something real quick. All right. There we go. So taking a look here at the S&P 500, we're not really all down from all-time highs. We're only down about 6%. So, it's not really a bear market for the S&P, but if you understand the makeup of the S&P, then it starts to make sense. Well, those companies that are about 20 something percent of the portfolio of the S&P aren't really down, right? The only one that's down a lot is Meta, but the other ones aren't really down. And so you have these inflows coming in, they're going into these index funds or they're going into these companies, and a lot of it's just flowing into the higher market cap weighting. So this is, it's interesting. But this is where things start to get concerning. And remember, keep in mind what I said, even though I'm saying all these things, oh, no, we're all going to perish. No, that's not what I'm trying to convey. I'm just trying to convey caution. And at the end, I'll kind of explain what it is I really think should be the actions that investors should take, right? Okay. And those will be just my opinion, but, you can just say, he's full of it. So this is the change in margin debt. Okay. So this is what is more concerning. Okay. And this is in billions of dollars. So now we're at a very high leverage point in the system. Right? We're actually at a higher leverage point than 08. Okay. And we've had fluctuations here and there, but usually these downturns, remember 2016, they very much coincide with leverage or changes in leverage. So we are at a point where leverage is extremely high. Should interest rates rise, and I've been talking about this for a while, this is the liquidity crunch right here. This is what I'm concerned about, and I've been talking about for a couple months now. The liquidity crunch is when basically all these debts have to be paid off. And actually, there are other very, very intelligent creators who I will actually mention their names. If we look at Stephen Van Meter, who makes YouTube videos, he actually talked about the bet against the dollar. This is a form of betting against the dollar. If you borrow money to buy assets, right? Remember, I have my disagreement on his timing of things, but I agree with his underlying premise. And I would love to actually interview him one day. When this channel is bigger, I'll bring him on and we'll have a blast. But if we take a look at the underlying premise of his argument, borrowing money is betting against the US dollar, because what you're doing is you're saying, you're shorting it. I'm going to take this dollar, I'm going to sell the dollar, get the asset, and then I'm going to sell the asset and get the dollar at a later point. That's short selling. That's essentially short selling. So borrowing money is shorting the dollar. When you borrow, you get a mortgage, anything like that, you are shorting the dollar. Okay. So in essence, what I'm looking at here is everyone's kind of betting against the dollar right now. And when everyone's betting against the dollar or betting against something, and they all think it's money printing, they all think QE is money printing, I start to get a little concerned, because I know just for me, my facts are, and again, we could disagree on the facts. my facts are QE is not money printing, right? The government is borrowing money. And we'll actually look at more data further. But again, the government's borrowing money. QE is not actually money printing, it's just an asset swap, blah, blah, blah. And we have to look at the lending growth of the banks, and they're not actually lending. And we see inflation for other reasons. And then we see fiscal spending. Yes, that's inflationary. Misallocation of resources, supply chain problems. Yes, all that's inflationary. What we see here is it's kind of a concern to me, because I think everyone's making a leveraged bet on something that I don't really necessarily agree with. But does it mean I'm selling all stocks again? No, I'm not. I have a good cash position. Am I planning? Am I timing the market? No. All I'm doing is I'm selling stocks when I think the business fundamentals do not reflect something that I'm comfortable with in the future, or and I'm not buying new stocks if I just don't find the value. Okay, so I'm not timing any market, and I actually will make a video on that, on when to sell specifically on that topic, and also what my thoughts are on quote unquote timing the market. Okay, a spoiler, I don't think it's a good idea. Leverage, right? This is basically the summary of leverage. Next, I'm going to talk about the missing growth, and you guys have seen this chart. I've shown this chart before on this channel. Let me just pull it up real quick. Yeah, it's really important. And again, Jeff Snyder's done a really good job, and Dr. Lacey Hunt, of kind of showcasing or talking about this. So we're actually below trend line, and this is what's concerning. I'm not going to pull up the Shiller's PE, because the Shiller's PE, I guess everyone's already seen that. Every channel talks about that. But this is what's I think is concerning. So we see that the real GDP growth should be trending at around this line right here, but we are way below trend line. Okay, this is the equivalent. I think it's like in compound terms, it ends up being several United States GDPs. Something like that in terms of total missing potential, which a lot of people, they have a hard time comprehending that, or kind of wrapping their heads around, because it's such a large number. But when you actually start to think about it, it's really big. We don't know exactly or pinpoint. We have assumptions, we have guesstimates, we have theories as to what's really going on. Dr. Lacey Hunt will tell you it's because of the debt cycle. Government debt has a negative growth factor, or a growth factor below 1. So a growth factor below 1 actually causes a negative percentage, because basically when you multiply a number by a decimal that's not greater than 1, you're actually multiplying it and decaying it over time. So like, for example, multiplying by 0.8 causes a 20% decrease, right? So Dr. Lacey Hunt's kind of pointing out that, hey, government debt has a negative growth factor. It's actually causing growth to decline, right? And private sector debt has a positive growth factor. So you actually want more of that. But you see Japan's having a hard time getting that. They have a really hard time getting private debt to grow. And they're doing everything that they can. And then they're just growing public debt. And then growth is, guess what, where it's going? It's basically declining. The only thing that's really contributing to growth is really innovation. So innovation, in that sense, actually allows for this economic growth. And then, the rest of the world economy, so companies can actually export and go to growing economies. So it's very complicated. Macroeconomics gets really tough, but I hope this kind of makes sense right here. This is the real GDP per capita. We're basically below trend line. Very concerning, because if we don't actually get back up to trend line, we can really hit overvalued territory very quickly, where numbers start to not make sense whatsoever. They're already starting to get there, if I'm being honest, for a lot of companies, right? And then this actually affects all of our modeling. So when we do stock analysis on this channel and we're modeling things out into the future, this affects our perpetual growth rate assumptions. This affects where we think the T-bills are going to be, everything, right? And again, if you really subscribe to or ascribe to Jeff Snyder, the Fed doesn't actually control yields. So once you take that pill, there's no coming back. But and I'll be honest, I've kind of taken that pill. All right, but I think that what we'll finish off with is diminishing returns. And this is, again, the work of Dr. Lacey Hunt, who's kind of pointed this out beautifully. And this is, again, basically going over the private debt or public debt. So this is actually the diminishing returns from debt. And this is showcasing the negative growth factor that really occurs. So as the countries have grown in debt, right, we see diminishing returns in each time. And this is concerning, because the only thing these countries really are doing or know how to do is to take on more debt. And this is sort of the newer era policies. So you have a unemployment program, and then you don't have the money to fund it because you can't take it from debt. And actually, we enter into the economic trap, right? Because if you don't have the ability to tax it, right? That doesn't mean you raise taxes and you get more money. There's actually a trap with that. So if you look at, for example, the data of the United States, going back all the way since we recorded it, the government has only been able to collect about 16.7% of GDP in form of taxation. And so regardless of tax rates, it didn't matter where tax rates were. That's what's concerning. And no one really talks about that. Politicians, when they say, oh, I'm going to raise taxes to fund this, it's not actually true. Statistically speaking, going back all the way, all the data that's available. And then every country is different. Some countries are better than others. The United States is actually at a higher level. So the United States is already in a good spot. But if you go countries like Italy, where there's tax evasion and kind of built into the culture, it's okay, I'm Italian. They have a difficulty actually collecting taxes at the same percentage rate as other countries. Same with Brazil. My wife's Brazilian. They have, again, a big problem actually collecting taxes. So if you think about it in that sense, you can't just say, I'm going to raise taxes to get more money. It actually doesn't work out that way. It's actually far more complicated. You see, when we simplify the situation or we simplify the scenario, that's where we tend to make mistakes. And imagine if a politician does that or a centralized authority does that, you make huge mistakes because it actually affects decisions. Okay. So taking a look at this chart, it's pretty straightforward. Basically, each time that we borrow more and more and more, we're getting less and less returns. And then what we're going to do going forward is borrow more and more and more, because that's all we know how to do. And in order to get out of this situation, that's what we're going to do. All right. The other thing is kind of talk a little bit about Jeff Snyder's work and kind of finish off with this. So a lot of people don't really think or understand that the United States actually never recovered from 2008. Right? You think that we have, but we really haven't. So, sorry. So if we look at, for example, labor force participation rate, and I'll actually pull that up for us. Yeah, if I pull it up right here, you can kind of get an idea. So this is the labor force participation rate. So what you can kind of take from this data is, you had the women entering the workforce and all that. And so obviously, statistically, that's going to increase the rate at which people are actually rejoining the workforce, because all this population that was kind of wasted potential is now realizing its potential, and they're coming and they're producing value. And so you have more consumers, more people producing money, more people producing resources. Because if we think about it, you want as much participation as possible, because those are people who are going to produce things, produce value, and put it into the system. And so you are a consumer as much as you are a producer. And as long as we have enough producers versus consumers, things kind of balance out. We actually experience a lot of economic growth. This is why countries, for example, we want populations to rise over time, because that increases the amount of production capacity from the labor perspective, and also from the consumption capacity, because we want more people to be able to consume these goods and services, and as well, as produce them. So this is something that really people aren't talking about. If you look at 2008, right? And I'd say people aren't talking about. Jeff Snyder's been screaming about this for quite some time, since about 2008. So this is kind of what he coins as the silent depression, that we've been in the silent depression. It's not really talked about. Governments around the world are going nuts. This is actually why they're borrowing so much. They're seeing this. They're definitely seeing this. Okay. People who are in government definitely know that this is happening, right? And that's kind of why we're seeing their actions, what they're taking. But we are not, as investors, we need to kind of piece all these things together and kind of make sense of what it is that's going on. So here we see after 2008, which is around here, this is actually the collapse of 2008. We see the labor force participation rate just collapse. And then it steadied out around here. This is actually where Donald Trump started taking power. This is the Obama administration. And so unemployment actually collapsed. If we take a look, we're going to take a look at the unemployment rate, which is a funny statistic. But when you actually look at it in tandem with this, things don't look so rosy as they do with just the unemployment rate. And then now we see the COVID lockdowns, right? And then now we're at where we are now. We're basically almost back in the 60s, early 60s. So let's take a look at the unemployment rate, and we'll see what the government kind of highlights there, because I think it's quite interesting looking at the differences between that and what they kind of showcase as, oh, this is good, this is not good. It's always really interesting to see what the government says in that regard. All right. So this is the unemployment rate according to the statistics of the U.S. government. We see unemployment rate rise, and actually, now we'll just go back and forth. But I want you guys to actually think of this and look at it back and forth, and kind of, so your brains can it will click. I definitely guarantee it will click. So October 7th, March 2008, we see it rise, skyrocket to about 10%. And then we see it decline. All looks really good, looks fantastic, right? Because if we consider that, this looks really good. right? Remember, what was US growth during that time? Was it really good? Do you guys remember that? You know, like looking and saying, oh, the US is growing so much. No, you actually don't remember that, because even everyone was talking about it. It's very slow growth, and people don't understand why. So if unemployment is coming down, people are, getting jobs, right? That statistic is very misleading, because it's just saying, okay, people are getting jobs. And remember, unemployment is a measure of people who are looking for jobs and then working. Labor force is very different. Labor force is probably a better measure of the total actual health of an economy, in my personal opinion. In terms of its capacity, its ability to produce value and economic growth going forward, labor force is far more important than unemployment rate. Unemployment rate is excluding a ton of people. It's only including people who are looking for work and can't find a job, right? All right, so this is coming down, so it looks really good, and then skyrockets, and then it looks really good now again. Okay, well, let's segue back to that chart. So memorize that chart and then come back here, and here we are. All right, so remember, we start around here. This is, again, 2008. We see a crash. Okay, as if you are removing this counter, of course, it's going to start to look better, because a lot of people are just not participating anymore, right? We had a height in 2000. This was a height, right? This was the peak. And ever since then, we've been in a decline, right? So if you remove a bunch of people from the equation who are not actually looking for work anymore, they just don't care. They're not working. They're not participating for whatever reason. We don't really know why, but we just know that this is happening, by the way. Or at least maybe I don't know why. Other people might know why. Okay. And then we see it rise again steadily, and then it collapses. And now we're around here. We're actually, if I were to extend this data, it's not really moving. So we don't know what to do with this, because this is very concerning. This is removing a lot of economic capacity, because if you understand now, the economic growth was very anemic, but under this backdrop, it makes a lot of sense. A lot of people were just not participating anymore. And we're removing, or we are not removing, it's just simply going away. It's eroding, and we just don't understand why. Okay, so that's kind of covering a little bit about the economic backdrop, and now we'll kind of segue off with just my personal opinion. So if you looked at all that and you think it's doom and gloom, don't think that. What I do in that regard is simply I don't care. I just buy businesses when I think they're good, and then I kind of look at the economic backdrop as kind of a side note to kind of, it does influence some of my decisions. I'll be very clear. So I don't make it dominate my decision making. So I'm not going to say, oh, look at all these problems, I'm going to sell out of everything. No. I look at it in isolation, and I look at the businesses in isolation, and I see what is a good value at a given time. Remember that when I say the word value, I don't mean value investing, growth investing. I don't actually agree that those exist. I think everything is just value investing, if you want to be clear on what value means. So an expensive stock, high PE ratio stock, is a value stock that's growing a lot. A stock with a low PE, traditionally a value stock, is expensive if it's decaying in growth and it's not growing at all. So everything is nuanced. And then the macroeconomic backdrop, I use it to kind of take that information, and then I say, okay, am I going to be very aggressive? Am I feeling very aggressive in terms of buying? What is everyone else thinking? Is everyone else really bullish right now, or is everyone else really bearish right now? That does affect, my deployment of capital, but it's not, I'm just looking for a business. If I like it, I'm going to buy it. If I find a piece of property, numbers make sense to me, I like it, I'm going to buy it. It doesn't matter to me. I don't really care. I don't make my entire portfolio decisions based on that. It does just influence little details about it. It may influence what specific asset class I want to be exposed to. Maybe I don't want that many REITs right now. Maybe I want more insurance plays. I'm not saying that that's actually the case, by the way, just giving examples. And then, it might change that, but it doesn't change, oh, I'm going all in on stocks now. Oh, I'm getting out of all stocks right now. No. But I hope that kind of helps. I'll have more detailed videos on when to buy and when to sell, or like my looks or viewpoints on that. But I hope this video helps you guys. And if it provided value, go ahead and feel free to leave a like. If you want more content like this, go ahead and subscribe. These are not the stock reviews or the stock subscriber request videos. These are more the conceptual ones that I do here and there. This one goes into that economics kind of one or talk that I do here and there. But on that note, guys, I hope you guys have a great one. I'll see you guys on the next one. Bye.